happens here, even though it ends calmer. And this is where the issue is. That 77,200 put option for Sensex moved from 54 rupees to 499 in 10 minutes. We're talking about Korean options doing so much. Look at what's happening back home in India on expiry days at least. But so why is it that this is happening, right? There is a thin book and fat tickets. I think you can almost coin it this way. And what's happening out there? Because the expiry places hedges, unwindings, passive rebalancing and prop flow in the same 10-minute book, because now there is a special session for it, and all of them come at the same point of time. Currently, the small cash order can really make sure that the lean IEP, which is the discovered price, while the real money sits in the larger options book. Remember, from 315 to 330, there is no continuous matching, which is very separate or very different from what used to happen. So if this is confusing you, what is the eventual take on the closing auction system? And we'll come back with this a bit later on in the day. But there is an issue because the market is thin, and cash could continue to have teething issues for a lot longer period of time, because the Indian markets don't have the liquidity depth that some of the global markets have, where cash is functioning very, very smoothly. Small traders would do well to not trade index options on expiry day, at least not be on the selling side, because then you could be caught on the wrong foot. And the system will work better with more participation, but let the risk be that of institutions. If you're a retail investor, don't try to take that risk right now until the situation gets resolved and more participation comes in. Remember, mutual fund participation has moved up. I think give it some time. Don't trade for the next 3 to 6 months on expiry day in put and call options, especially on the short side. That's the simplest thing to do for a retail participant. But we've had a fabulous conversation when the closing auction system began with Emkay Global's Manjiri, and she joins in right now. She heads the dealing out there, and it'll be lovely, Manjiri, to talk to you, understand. Now that you've had a month and you've seen the first Sensex expiry as well, what's the takeaway according to you?
So, I think we would definitely have an initial teething issue, as you rightly said, that anything which is introduced first time would have some issues. But I think it's something which on a long term would really work very well as far as the other developed markets work. The bigger issue with us is we have weekly options and the monthly expiries where a lot of options are sitting. And all the closing happens on the closing option session basis. So that is where the bigger issue right now is. As far as you were talking about the indicative price, the way you look at indicative prices, it will always be a little faulty, because you can always withdraw the order also. So not necessarily the order is in the system when actual price matching happens. You can always put the order and withdraw it, and the indicative prices can keep on moving. So trading options in live market based on indicative price itself is not the right benchmark for trading. And that is where we can see huge volatility happening. Definitely not necessarily everyone is looking at it in trading, but with price moves, you will have a lot of stop losses which get triggered, and further the price gets expanded.
Yeah, it's an important point. Samir Arora is with us, and Samir is waiting by as well. I do want to acknowledge that he's joined us. Samir, we'll come to you in just a bit because we want your opinion on this. We know that you study this very deeply as well. But Manjiri, I just want your perspective on, from the writer's perspective, right, of these derivative contracts. It's becoming less and less lucrative to do that. And so in the interim, while we're waiting for the dust to settle, it's actually something you'd warned us about, to say that on expiry day, you will have chaos. Yeah. Tell us from the writer's perspective, what do you do?
Yeah, so ideally from a writer's perspective, as I said, it's a black box. It's very tough to anticipate where the closing will come. And that is where the risk, as far as the writer is concerned, would play on. But I feel somewhere we have to relook at how the pricing is happening for the closing option. And if we can, for weekly options, can we actually move to the reference price, which is a more traded price, where we have a lot of arbitrageurs also who are liquidity providers in the system, and where the price is little fair. So can we have a closing auction which works the way it works, and we have a reference price where weekly options or monthly options close? Something which can be looked at, where there is more liquidity. Like yesterday, we saw a lot of stocks where they moved around 2 to 3% on very low volumes in closing auction. And that finally decides the closing for the month.
Exactly. Exactly. Manjiri, we hope to have you back for a more detailed conversation because I think we need to give this a little more time and then figure how it settles. But we really appreciate your time today. Manjiri Muzumdar there from Emkay Global. And I want to welcome on to the conversation Sameera Arora, founder and fund manager, Helios Capital. Sameera, very good morning to you. And we're not going to spend the entire time of our interview talking about this, but I think